Hello, welcome to this wonderful new chapter called Over the Counter Derivative or Swaps. In this chapter, we are going to learn about swaps, we are going to learn about interest rate risk management. So, our focus of this chapter would be swap. Under swap, we will study interest rate swap, very important for your exam, and currency swap, cross currency interest swap, cross currency interest swap, and then we are going to discuss about interest rate risk management. So in this chapter, the underlying would be interest rate. The underlying would be interest rate. So what we are going to discuss under interest rate risk management, forward rate agreement, FRA. We are going to cover each of them one by one, so don't worry. Then we are going to discuss interest rate options. So this option will not leave you. In this chapter also we have interest rate option, we have interest rate futures. So option and future will be there in this chapter also. Then we will also discuss about swaption, and under interest rate option we will also discuss about cap, floor, collar, like this. So this is a very interesting chapter where the underlying would be an interest rate and how to reduce or hedge our risk. We will discuss that. So first discussion today will be on swap. What do you mean by swap? This word swap means exchange. The word swap in general meaning is exchange. That means two parties are exchanging certain things. Like in the exam hall, A is sitting here and B is sitting here. Okay, A and B are sitting on the respective benches, and then the examiner is out, so they swap their places in the exam. I hope you don't do that, but that is also a kind of swap. In this chapter, of course, we are not talking about such kind of swaps. We are talking about financial swaps. So what is a financial swap? Swap of cash flows. Swap of one set of cash flows against another set of cash flows. Simply speaking, one party will pay dollar to the other party, and this other party suppose pays rupees to the first party. Then this is a swap of dollar with rupees, and this type of swap we called currency swap. Or the more common, which will be discussed in this chapter more often, there are two parties with fixed rate of interest and floating rate of interest. So they can swap their interest obligation. This party's fixed rate obligation will be transferred to the other party, and the other party will transfer his floating rate obligation to the first party. This way they can swap their interest rate liability. So financial swap means exchange of two set of cash flows. Why would somebody swap their cash flows? That is a question that you are trying to ask. Why would two companies swap their cash flows? So the answer is, the two firms in two different markets may have relative strength in borrowing in two different currencies. To understand this example, suppose a US company wants to borrow in Japan. A US company wants to borrow in Japan, and at the same time a Japanese company wants to borrow dollar. It needs dollar for its US operations, so it wants to borrow in dollar. If a US company goes to Japan and borrows Japanese yen, JPY is called Japanese yen, then it will have to pay, for example 10% interest. If your US company directly goes to Japan and borrows, it will have to pay 10% interest. But a Japanese company which is a reputed company in Japan, well known in Japan among the investor community, can borrow in its own country and in its own currency at, for example, 6%. If a Japanese company like Sony borrows in Japan, where it is well known, it can borrow at 6%. But a US company, some XYZ US company wants to borrow in Japan, Japanese investors are not aware about what is this US company. There is a risk involved, it's a foreign company, our money can be lost, so they may demand a higher rate of interest. Now see the reverse story here. If a Japanese company wants to borrow in USA, in US dollar, they may have to pay 8% rate of interest. But a US company can borrow in US dollar at say 2%, because a US company is known amongst the investor community in USA, but a Japanese company is not known. So what they will do, US company has the relative strength in US market, Japanese company has relative strength in Japanese market. How they can minimize their cost of borrowing? The Japanese firm will borrow in Japan at 6%. Japanese firm will borrow in Japan at 6% and give loan to US company at a lower rate, let us say 6 or 7% or 8%. Similarly, a US company will borrow in USA and give loan to Japanese company at 2, 3, 4, 5%. Still, it will save lot of cost for the Japanese company. So that is why the two companies will come into a swap contract, will enter into a swap arrangement. And who does all this swap arrangement? There are investment bankers. There are big dealers, brokers who arrange for such deals, and they get their own commission in that process. So these big investment banking companies, they are involved in arranging for such swap transactions. We as a student or as a common person, we may not come across such transaction, but yes, at a large corporate level, banking level, this kind of transactions do happen. Next line, swap is an arrangement whereby a firm borrows in the currency in which it has advantage. Refer the example. Japanese company will borrow in yen, US company will borrow in dollar and exchange the liability with other firm for an equivalent liability at the time of agreement in another currency. So US company will first borrow in dollar, give the loan to Japanese company will borrow in Japanese yen and give the loan to US company. So normally the amount will be equal. Amount will be equal means if $1 is equal to suppose exchange rate $1 is equal to 120 yen. This is the symbol for yen. So it means they will swap $1 million will be swapped against 120 million yen. So the amount swapped will be equal, keeping in account the exchange rate between the two currencies. Another example of swap will be, one firm may have advantage in borrowing at fixed rate of interest, the other firm may have advantage in floating rate of interest. So I am going to give you one example on this also. Suppose there are two entities, A and B. Fixed rate of interest applicable. Fixed rate of interest means the rate of interest will remain fixed for the entire term to maturity. If A goes to the market to borrow at fixed rate, A will have to pay 8. If B goes to the market, B will have to pay 10. And now you see floating rate. Floating rate means the rate of interest will change. It is linked to a benchmark rate. For example, the benchmark rate can be LIBOR, London Interbank Offer Rate, LIBOR, London Interbank Offer Rate, the rate of exchange, rate of interest in London market, London Interbank Offer Rate of interest at which one bank lends to another bank in London Interbank market. And suppose that is here LIBOR plus 2%. If A borrows, it will pay LIBOR plus 2. But if B borrows at floating rate, then B will have to pay LIBOR. Now who has advantage in fixed rate? A. Who has advantage in floating rate? B. And what are their requirements? Requirements means, what do A want? A wants to borrow in floating rate. A wants to borrow in floating rate. B wants to borrow in fixed rate. A wants to borrow in floating rate, B wants to borrow in fixed rate. If they act independently, A will have to pay LIBOR plus 2 and B will have to pay 10%. But then what they will do? They will enter into a swap contract. How do they enter into a swap contract? A will first borrow at 8%. B will borrow at LIBOR. And then they will swap each other's interest obligation. So B will pay to A LIBOR every year, which A will pass on to its banker. A will pay 8% to B and B will pass it on to its banker. So this way A will save 2%, B will save 2%. A will save 2%, B will save 2%. Instead of paying LIBOR plus 2, A will end up paying LIBOR. B, instead of paying 10%, he will end up paying 8%. So both parties will benefit in this deal. These two parties will be brought together by some investment banker. So that is the explanation of this line, that one party may have advantage in borrowing at fixed rate while the other may have advantage in floating rate. What is a floating rate? Floating rate, the rate of interest is linked to a benchmark rate. So the most popular internationally recognized benchmark rate is London Interbank Offered Rate or LIBOR. So this term LIBOR will appear again and again in this chapter, which is London Interbank Offered Rate, the rate of interest at which one bank lends to another bank in London market. It is a complex average of various rates in London, but we are not interested in how it is calculated. And LIBOR is usually changing every day. So based on what LIBOR you have entered into, it will keep on revising. The parties may agree that they will revise LIBOR every 6 months. So after 6 months, if the LIBOR goes up, you have to pay more interest. If the LIBOR falls, you have to pay less interest. So the one who has borrowed at floating rate has a risk that the LIBOR may go up, and therefore he may have to pay more interest. So what he can do, in order to reduce his risk, he can swap his floating rate interest liability into fixed rate interest liability. Therefore the swap may involve borrowing at floating rate and exchanging the liability for payment of interest with another firm borrowing at fixed interest rate. So what happens, with the help of swap, you can convert your floating rate obligation into fixed rate obligation. You can convert your floating rate obligation into fixed rate obligation. Now the student is asking a question. If I have borrowed at floating rate, you have already borrowed at floating rate. You are afraid that the benchmark rate like LIBOR will go up and you will have to pay more interest. So one option is you prepay this loan. He is asking me, the student is asking, you can prepay this loan. Suppose it's a 5-year loan. You prepay the floating rate loan. Think about it, whether he's asking a good question. Yes, you can prepay the floating rate loan and issue fresh loan, take fresh loan at fixed rate. Take fresh loan at fixed rate. That is a good question. Can we not do this? If you are afraid that the rate of interest will go up, why don't you repay the previous loan and issue fresh loan at fixed rate? So this will also convert your floating rate into fixed rate. You are right, dear student, but when you do prepayment, so I am not sure whether you know that in case of certain loans, the bank or the lender will charge you prepayment charges. There is a prepayment penalty because the lender had given the loan assuming you will keep the loan for 5 years, 10 years, and he will enjoy the interest. Accordingly he negotiated, accordingly he planned, and now you are coming after 6 months and you are saying that no, I don't want this loan, please take your loan. So there are prepayment charges which can be say 2% or 4% like this. Plus when you will raise fresh loan, there will be floating cost. What is floating cost? Issue expenses or issue expenses, if you understand issue expenses, because raising of large amount of funds involves administrative cost, legal cost, advisory fees, negotiation fees, consultants fees, right, and lot of paperwork, management's time and energy is involved. So suppose the flotation cost is also 2%. So in all you may end up spending 4 to 6% of the value of the loan in prepayment charges and flotation cost. Instead of that, you can pay 0.25%, 0.5% commission to a investment banker, and he will arrange for a swap whereby you convert your floating rate into fixed rate. That is much cheaper. So swap can be a low cost mechanism. Swap can be a low cost mechanism to convert your floating rate into fixed rate. So I have made a small summary of what are the motivations underlying swap. Why do companies enter into swap arrangement? One reason is capital markets are imperfect. You cannot easily raise funds from anywhere you want. Indian company suppose wants to raise funds in Denmark. An Indian company wants to raise funds in Denmark. Will a Danish investor invest in an Indian company? No. But similarly, a Danish company wants to raise funds in India. Will you, the Indian investor, are you going to invest in a Danish company? No, you will say there are a lot of Indian companies where I will invest. Why will I invest in some foreign company located in Denmark? They may not refund our money, and where will I chase them? So what this Indian and Danish company will do, they will enter into a swap. Indian company will take loan in India, give the loan to Danish company in India. Danish company will take loan in Denmark and give loan to Indian company in Denmark, and this way the swap helps you to achieve those objectives which otherwise was not possible. Second motivation underlying swap is difference in investors' attitude. Somebody wants floating rate of interest, somebody wants fixed rate of interest, somebody wants to borrow in yen, somebody wants to borrow in dollar, and then if they find that doing that transaction himself will be more expensive, they will enter into a swap arrangement. Information asymmetry. Informational asymmetries means the two parties, the two firms may not have the same level of information. Based on the level of information which they have, one company may be thinking that interest rates will go up, the other may think interest rate may go down. Differing financial norms, very important tick mark. Differing financial norms means, as we have seen earlier, a company can borrow at fixed rate of 8%, but floating rate at LIBOR plus 2%, while the other company can borrow fixed rate of 10%, but floating rate of LIBOR. So therefore, the financial institutions or the lenders apply different norms for different category of borrowers. By entering into a swap, you can reduce your borrowing cost because of differing financial norms. Another reason for entering into financial swap can be difference in the regulation and tax structure. So you can bypass these national regulations, you can reduce your tax liability by entering into swap arrangement. And the next point is borrowers and investors differ in their preferences and market access. Borrower wants to borrow in floating rate, investor may want to invest in fixed rate. So how this transaction will happen? Then borrower will first borrow at fixed rate and then swap it with somebody who wants floating rate, like that. And then different people have different access to the market. Indian company may not have access to Japanese market. Japanese company may not have access to Indian market. But through swap, they can raise funds in the currency that they want. So borrowers and investors with mismatched assets and liabilities who would like to shuffle their balance sheets. So this point also I'll explain why companies enter into swap. Suppose this is a, let us say, bank. Banks have liabilities which are mostly deposits and borrowings. The major liability on the liability side will be deposits and borrowing. And what about the assets? Their maximum assets will be in loans and advances. So the risk can be that these loans and advances are in floating rate. That means they will receive interest at floating rate, but these deposits and borrowing are at fixed rate. So here they are going to receive interest, they are going to pay interest at fixed rate. So liability side has fixed rate, asset side has floating rate. Now for some reason the rate of interest has gone down. RBI has reduced the interest rate. So you will also have to reduce the interest rate which you are going to charge to your customer because it is linked to, let's say, RBI rate, but your borrowing is at fixed rate. So this will cause loss to the bank. So how to reduce your loss, eliminate your loss? You can enter into a swap transaction whereby you can also convert your fixed rate liability into floating rate liability. So if the interest rate falls, on liability also you'll have to pay less interest, on asset you are receiving less interest. So through swap one can manage the asset and liability, and that is called asset liability management. So banks can use swap for their balance sheet asset liability management. Swaps are useful for doing such transaction which otherwise would be very expensive. American company borrowing in Japan will have to pay 10% interest. But by entering into a swap with a Japanese company, it will have to pay 6% interest. So what you can do directly at a high cost, you can do the same thing at a very low cost with the help of the swap. With the help of swap, you can do such transactions which otherwise may not be either possible or possible only at a very high cost. So these are the motivations underlying swap. Okay, now we'll come to the next discussion, types of swaps. So that is what we'll study today, different types of swaps. One is called currency swap, second interest rate swap, on which we have many questions, and the third is cross currency interest rate swap. Cross currency interest rate swap is just a combination of both the currency swap also and the interest rate swap also. So this one is a combination of currency swap plus interest rate swap. So today first we'll see currency swap. Remember the example of a US company and a Japanese company. US company will give dollar to the Japanese company, Japanese company will give dollar to the US company. So on day one they will exchange the principal. Today they will exchange the principal amount, and suppose it's a 5-year loan. Next 5 years they will exchange the interest, and again on maturity they will re-exchange the principal amount. That is called currency swap. The objective of currency swap is to reduce your cost of funding. Also it will help you to achieve some objective which otherwise cannot be obtained. So first, paragraph number 3. Now this was a theory question also in the exam, so you please mark theory question for 4 marks in the exam. Theory question for 4 marks in the exam can be asked directly. Write a note on currency swap. What is a currency swap? It's a contract in which two parties, the two parties usually maybe two different companies in two different countries, exchange specific amount of two different currencies at the outset. So they will exchange the principal at the beginning, exchange interest payment in the two currencies over the term of the swap, and re-exchange the principal on maturity. So today they will exchange principal, then during the term of the loan they will exchange interest, and on maturity they will re-exchange the principal. This we can understand with the help of a diagram printed below, where we have 3 steps. Step number 1, this is party A, this is party B. So party A will give yen principal to party B, and party B will give this dollar principal to party A. So party A seems to be a Japanese firm and party B seems to be a US firm. So on the first day they will exchange the principal. The amount of principal will be based on the exchange rate. For example, if exchange rate is $1 equal to suppose 120 yen, then for exchanging $10 million this other party will pay 1200 million yen. So the exchange of principal amount will be equal based on the exchange rate. Next point is exchange of interest. Suppose it's a 5-year loan. Now who will pay yen interest to whom? Party B will pay yen interest to party A. B will pay to A. And suppose they have agreed the rate at 5%. And A will pay to B interest in dollar. Suppose they have agreed at 12%. In this example, this 5% is fixed, this 12% is fixed. So this is called fixed to fixed swap also, because both interest rates are fixed. Sometime one can be fixed, the other can be floating. Then that will be called fixed to floating swap. Fixed to fixed. This diagram is for fixed to fixed, because both parties are paying fixed rate of interest to each. Then your question will be why this is 5 and why this is 12? Because in different countries interest rates are different. In India the interest rate is 8%, but in USA the interest rate is 4%. In Japan the interest rate is 1% or 0.5% or 0%. So accordingly the interest rate will be different in different countries. That is possible. So this interest they will keep exchanging till the period of the loan. If the loan is for 5 years and assuming annual interest payment, so every year they are going to pay interest to each other. And then what will happen on maturity? On maturity, suppose it's a 5-year loan, B will repay yen principal to A will repay the dollar principal to B. So this is a very good and simple example of currency swap. It's printed in your book. Just ensure that these arrows are properly drawn there. If something is not drawn, then you can just mention there. So this is currency swap diagram. In the exam, what you will do when you write a note on currency swap, first write the meaning and then you draw this diagram, and after that you write the benefits of currency swap. The major benefit of currency swap is cost cutting. If an American company borrows directly in Japan, it may have to pay for example 8%, but through the swap it may have to pay only 5%. A Japanese firm, if it borrows in US, may have to pay 15%, but through swap it may have to pay 12% only. So they are able to reduce their cost of funding. So cost of funds reduces. Both party will use their respective strength and try to reduce the cost. Second benefit is that it enables access to a sector of international capital market which otherwise is not available. An Indian company has to raise funds in Denmark or Sweden. They cannot do it directly because there the investor in Denmark, Sweden may not invest in an Indian company. Similarly, a Swedish company may want to raise funds in India for some local project here. Probably they cannot do that, but they can enter into a swap arrangement. Indian firm can enter into a swap arrangement with a Swedish firm and they can raise funds in that currency. Third benefit is diversification of sources of fund. Yes, you should, just like we diversify our investment, we should also diversify our sources of fund. We should not depend on only one source of fund, otherwise that can be difficult for a business. And point number 4 is risk reduction. Foreign exchange fluctuation risk is reduced. A US company will get the funds in Japan only, in Japanese yen. So they don't have to convert dollar into yen or yen into dollar. The firm has a business operation in Japan. They will get funds in Japanese yen. They will pay interest in Japanese yen. They will repay the principal in Japanese yen. So especially your foreign exchange risk is reduced. So write down foreign exchange risk is reduced because there is no conversion required. Conversion from one currency to another currency is not required. So exchange fluctuation risk is eliminated. Actually, it is already written in your book. So these are the benefits of currency swap. So theory question will contain these 3 paragraphs, and if you have the time in the exam, then you can add one more paragraph, types of currency swap. Fixed to fixed currency swap, fixed to floating, cross currency swap. What is a fixed to fixed currency swap? This diagram printed in paragraph 4 is a fixed to fixed currency swap. One party pays 5% interest rate, the other party pays 12% interest rate. So it involves exchanging fixed interest payment on a loan in one currency for a fixed interest payment on an equivalent loan in another currency. And then what is the fixed to floating currency swap? Under this method, fixed rate obligation in one currency are swapped for floating rate obligation in another currency. Fixed rate, one party will pay fixed rate, the other party will pay floating rate. So when one party pays fixed rate and the other party pays floating rate, it is a combination of currency swap also, because currencies are also being exchanged, and fixed rate is swapped against floating rate, so it also becomes an interest rate swap. So that is why it is called cross currency swap. It's a combination of currency swap and interest rate swap. Example, US dollar at fixed rate can be swapped against sterling. Sterling means pound, currency of UK, with LIBOR plus floating rate. So we are exchanging two different currencies. We are exchanging dollar and pound. So this is currency swap, and we are also swapping fixed rate and floating rate. So that becomes interest rate swap. Therefore it is called fixed to floating cross currency swap. Right? Now the time has come to solve question number 1. Question number 1, mark important. This kind of question you can expect for around 8 marks, and that's a very easy problem. So what is this question? McDonald's hamburger company wishes to lend $5 lakh to its Japanese subsidiary. McDonald's wants to lend 5 lakh. Where is McDonald's? USA. And it has a subsidiary in Japan. So it wants to lend $5 lakh to its Japanese subsidiary. McDonald's is in USA. Subsidiary of McDonald's is in Japan. And the amount they want to lend is $5 lakh. At the same time, Sony Industry is interested in making a medium-term loan of approximately the same amount to its US subsidiary. There is a Japanese company, Sony Industry. They want to give loan to their US subsidiary. American company want to give loan to Japanese subsidiary. Japanese company Sony wants to give loan to its American subsidiary. So what will be the problem with these two companies? If they give loan directly, they will have to convert dollar into yen, and the Japanese company will have to convert yen into dollar. So exchange fluctuation risk is involved. And if they want to borrow directly in their Japan or USA, if McDonald's borrows directly in Japan, the interest rate would be high. If Sony borrows directly in USA, the interest rate applicable to Sony will be high. So what these two parties did, they will shake hand. Okay. And now see what happens. The two parties are brought together by an investment bank. That is, these are the banks which arrange for such deals for the purpose of making parallel loan. For the purpose of making parallel loan means McDonald's will give loan to subsidiary of Sony. Sony will give loan to subsidiary of McDonald's in Japan. So now you see the arrangement. McDonough will lend $5 lakh to the US subsidiary of Sony for 4 years at 13%. So Japanese company don't have to convert yen into dollar now. McDonough is in USA. Subsidiary of Sony is in USA. Loan will be given in US dollar. So there is no conversion of yen into dollar. And this question says principal and interest are payable only at the end of the 4th year with interest compounding annually, underline, with interest compounding annually. So in this question, they will not exchange interest annually. All the interest will also get accumulated, and principal plus interest, that is the future value, will be repaid, will be re-exchanged on maturity. Sony will lend the Japanese subsidiary of McDonough 70 million yen for 4 years at 10%. And what Sony will do? Sony will give loan to American subsidiary in Japan 70 million yen. Somebody would like to ask, $5 lakh is given by US company, then why Sony is giving 70 million yen? That is because of the exchange rate between dollar and yen. Again, the principal and interest annual compounding are payable at the end. The current exchange rate is 140 yen per dollar. Now you see the calculation. Exchange rate is 140 yen per dollar. So $5 lakh multiplied by 140 is equal to 700 lakhs yen, which is equal to 70 million. 700 lakh is equal to 70 million yen. So they have exchanged equal amount of principal today. Both parties will repay the principal plus interest after 4 years. US company will charge 13% interest rate to Sony. Sony will charge 10% interest rate to US company. Next paragraph, there is an important line. However, the dollar is expected to decline by 5 yen to the dollar per year over the next 4 years. So what will be exchange rate after 4 years? Can you guess? What will be exchange rate after 4 years? Today the exchange rate is 140. The question says dollar is expected to decline by 5 yen to the dollar per year over the next 4 years. So dollar will depreciate 5 yen per annum into 4 years. So the exchange rate after 4 years is expected to be 120 yen per dollar. Exchange rate is expected to be 120 yen per dollar. This is the basic introduction of this question. Now they are asking you 4 questions. I think this will be an 8-mark question whenever they will ask you. If this expectation proved to be correct, suppose whatever is mentioned above proved to be correct, what will be the dollar equivalent? Read the question again. What will be the dollar equivalent of principal and interest payment to Sony at the end of 4 years? So this question is how much amount this McDonough will pay to Sony after 4 years in dollar equivalent amount. Actually payment will be made in yen because Sony has given loan in yen, 70 million yen. So repayment will also be in yen. But they want to know what is its dollar equivalent amount. What is its dollar equivalent amount? So by first compute the answer in yen and then convert the yen into dollar by applying 120 yen per dollar rate. So that is your first answer. Second question, what total dollar will McDonough receive at the end of 4 years from the principal and interest payment on its loan by US subsidiary of Sony? So here we have to first find out how much amount Sony will pay to McDonough. Now here the amount is already given in dollar. So you just have to find out the future value of 5 lakh after 4 years by applying the formula 5 lakh into 1 plus r to the power 4. In the first answer, McDonough will pay to Sony. In second answer, Sony will pay to McDonough. Calculate both answers in dollar. Both answers will be calculated in dollar, and then you compare. First answer, McDonough is paying to Sony. Second answer, Sony is paying to McDonough. So third question is, which party is better off with the parallel loan arrangement? Which party is better off with the parallel loan arrangement? So we'll have to see who pays less. Who pays less on maturity? They have borrowed equal amount at the beginning, but on maturity the repayment may not be equal. So the one who pays less is better off with this parallel loan arrangement. If McDonough pays less in the first answer, McDonough is better off. If Sony pays less, then Sony is better off with the parallel loan arrangement. And then they are changing the question suddenly. They are asking that what would have happened if yen did not change in value. If yen did not change in value means we will have to do the calculation with 140 yen per dollar on maturity. So my first answer will change. Recalculate the first answer by taking 140 yen per dollar. Then again compare that answer with the second answer and see whether McDonough will still be better off or whether Sony will still be better off, or will the answer change. So very easy question, because it is just an application of future value formula. First I am going to present this question in the form of a diagram. Maybe that will help you to understand better. So take out your pen, pencil, notebook, draw the diagram first. Write down question number, page number, in bracket important. McDonough USA will give loan of $5 lakh at 13% to subsidiary of Sony in USA. McDonough USA will give $5 lakh at 13% to subsidiary of Sony in USA. And then next line, Sony Industry in Japan will give a loan of 70 million yen at 10% to subsidiary of McDonough in Japan. To subsidiary of McDonough in Japan. So this is the diagrammatic presentation, and now we'll write down some important information about this question. Spot rate is given is 140 yen per dollar. Spot rate is 140 yen per dollar. Then they are saying $5 lakh is equal to 70 million yen. So whenever you have a doubt how these two figures are equal today, it is because of the exchange rate. $1 is equivalent to 140 yen. So 70 million yen is equal to $5 lakh. Exchange rate at the end of the fourth year. Exchange rate at the end of the fourth year. The problem says exchange rate will decline by 5 yen per dollar every year for 4 years. So 140 minus 5 into 4. 140 minus 20 is 120 yen. First answer, write down answer A. Read the question again. If this expectation proved to be correct, if this expectation proved to be correct means if the exchange rate after 4 years become 120 yen per dollar, what will be the dollar equivalent of principal and interest payment to Sony at the end of 4 years? So first you look at the diagram above. This company, US company, has to pay 70 million yen plus interest at the rate of 10% per annum compounded annually to Sony after 4 years. So first I'll find out the amount payable in yen. First I'll find out the amount payable in yen because the original loan is in yen. Payment will also be made in yen, but we are only finding out what is its equivalent amount. What is the equivalent amount they have paid in dollar? So write down the formula of future value. This is a very basic formula in finance. Future value is equal to present value. Future value is equal to present value into 1 plus r to the power n equal to 70 into 1 plus 0.10 to the power 4. So solve this equation and you will get 102.487 million yen. But this is the amount in yen. The question says equivalent amount in dollar. So below that write down equivalent amount in dollar is equal to 102.487 divide by exchange rate 120. Divide by exchange rate 120. 120 yen is equal to $1. 102.487 yen is equivalent to how many dollars? So the answer comes to $0.8541 million. So in dollar terms, it is equivalent to paying $0.8541 million. Now write down B. Amount payable by subsidiary of Sony Industries. Amount payable by subsidiary of Sony Industries to McDonough in US dollar. Same calculation, but this time the amount is $5 lakh, interest rate is 13%, time 4 years. So dear students, solve this 5 lakh into 1.13 to the power 4. 5 lakh into 1.13 to the power 4. Check the answer. Is it $8,15,237? Yes. Now this is in million, this is in lakhs. So I'll convert this also into million. So this is equivalent to $0.815237 million. Now look at these two numbers. Who paid more or who paid less? McDonough has paid to Sony. McDonough has paid to Sony $0.8541 million. Subsidiary of Sony has paid to McDonough $0.815237 million. So who is better off with the parallel loan arrangement? Who has benefited in this deal? Sony has benefited. Sony has to pay less. So you will write down answer C. Answer C. Sony company is better off with the parallel loan arrangement. Sony company is better off with the parallel loan arrangement as it had to pay $0.815237 million. It had to pay $0.815237 million to McDonough, but it receives $0.8541 million from McDonough. But it receives $0.8541 million from McDonough. Answer is not over. There is one more question. The fourth question says, suppose the yen did not change in value, what would have happened? If the yen did not change in value, then instead of dividing this by 120, answer A at the top, this number 120 you would have divided by 140, and let us see what will be the answer. So write down answer D. If yen did not change in value, the equivalent amount payable in dollar equal to next line equal to 102.487 divided by 140, and that is equal to $0.73205 million. Now McDonough is paying to Sony $0.73205 million, whereas Sony will pay, this amount is already in dollars, so no correction required here, no change required here, 0.815237. So this time my answer will change. So you will write the concluding line. In this case McDonough would have been better off. In this case McDonough would have been better off with the parallel loan arrangement. McDonough would have been better off with the parallel loan arrangement, as the amount received is 0.815237 million dollar. Amount received is 0.815237 million dollar, and the amount paid is 0.73205 million dollar, and the amount paid is 0.73205 million dollar. So this answer is over. Very easy question. When you read it for the first time, it sounds difficult because there is so much of data there, but when you look at it closely, carefully, go step by step, the question was easy. Another very important question, tick mark, question number 2. This question was asked in the exam May 2011, 8 marks, RTP, May 2020. And this is another very easy question. A Inc. means incorporated, and B Inc. intends to borrow $2 lakh. So A intends to borrow $2 lakh, and B intends to borrow $2 lakh in yen. Means they want to borrow yen equivalent to $2 lakh. So $2 lakh multiplied by the exchange rate, that is the amount they want to borrow in yen. So amount is equal today. If I look at the current exchange rate, they want to borrow equal amount. One party wants to borrow $2 lakh, the other party wants to borrow equivalent of $2 lakh in yen, respectively, for a time horizon of 1 year. So this time we have to calculate interest only for 1 year. Previous question was 4 year. Be careful what they have given. The prevailing interest rates are as follows. Company yen loan, dollar loan. Now how to read it? If A wants to borrow in yen, A will have to pay 5%. And B will have to pay 8%. So who has got advantage in yen loan? So you will say A has got an advantage in yen loan, and by how much it has got the advantage? It has got an advantage of 8 minus 5, 3%. A has got 3% advantage over B when it comes to yen loan. Then let us come to dollar loan. A can borrow in dollar loan 9% at 9%, and B can borrow dollar loan at 10%. So who has the advantage here? Again A has an advantage, And how much advantage A has? 10 minus 9 equal to 1%. In yen loan, it has 3% advantage. In dollar loan, it has 1% advantage, where the relative advantage is high. The relative advantage is more in yen loan. The relative advantage is more in yen loan. That means it has got advantage in both, but the advantage is more in the case of yen loan. So that will be the reason for the note given below. The prevailing exchange rate is $1 is equal to 120 yen. So exchange rate is $1 is 120 yen. So this party wants to borrow $2 lakh. This party will want to borrow 2 lakh into 120 yen. No problem. They entered into a currency swap under which it is agreed that B will pay A. B will pay to A 1% over the yen loan interest. B will pay to A 1% over the yen loan interest rate, which the latter will have to pay as a result of the agreed currency swap. So now what is the question? A wants to borrow in dollar. A's requirement is dollar loan and B's requirement is yen loan. But for a currency swap to come into existence, first A will borrow in yen and B will borrow in dollar. And what they have agreed, that A will borrow at 5%, B will pay to A 6%. B will tell A, look, you borrow at 5%, but I am willing to pay you 6%, 1% more, which the latter will have to pay as a result of the agreed currency swap. Whereas A will reimburse interest to B. How much interest A will pay to B? B is borrowing at 9%, 10%, but A will reimburse to B only to the extent of 9%, because A has got an advantage over B. A has got an upper hand. So A will pay to B 9% interest rate on dollar loan. So the story is in summary form: A will borrow in yen at 5%, B will borrow in dollar at 10%. They will swap their interest liability, swap their interest and principal liability, under which B will pay to A 6%, A will pay to B 9%. Next paragraph, this I am going to ask you some questions, so I am not explaining further. Keeping the exchange rate invariant, don't change the exchange rate. Exchange rate will remain same, 120 yen per dollar. In the previous problem, we had changed the rate. Quantify the opportunity gain or loss component of the ultimate outcome resulting from the designed currency swap. So you will tell me, dear student, what is gain to A, what is gain or loss to B. Most of you will be thinking only A will gain here, but the answer is B can also gain in this deal. So think for 5 seconds and tell me what is the gain to A and what is the gain or loss to B. You can either answer in percentage or you can answer in amount. You can either answer in percentage or you can answer in amount. So 5 seconds begins now. 5, 4, 3, 2, 1. Time over. So the answer is both parties will gain 1% each. Both parties will gain 1% each. how both parties will gain 1% each. Let us think first. On yen loan, look at from A. A will borrow at 5%. So A has to pay to its banker 5%, but A will receive 6% from B. So 1% gain to A. And A is paying to B on dollar loan 9%, which in any case A would have paid to its banker 9%. So on dollar loan, A has no profit, no loss. But on yen loan, A will borrow at 5% and transfer to B at 6%. So 1% gain to A. What about B? B will pay to A 6% on yen loan. So B will get 2% benefit here. But B will receive 9% from A on dollar loan. So B will lose 1% on dollar loan because B has to borrow at 10 and give it to A at 9. So on dollar loan, B will lose 1%. But on yen loan, B will save 2%. So by saving 2 and incurring 1% loss, the net loss to B is also 1%. Answer over. Now you do it as homework. No sir, we want more writing. So now write down. This question can be answered only by looking at it without even writing anything. Both parties will benefit 1%. So 1% of 2 lakh, $2,000 benefit to A, $2,000 into 120 conversion rate, 2,40,000 yen benefit to B. But in the exam for an 8-mark question, you just can't write in 2 lines, 1% gain to A, 1% gain to B. Write down in detail. I will give you the answer in detail so that later when you revise your book, you can understand. And once again, we will discuss this answer while writing the notes. First, write down step 1, requirements. What is A Inc.'s requirement? A Inc.'s requirement is $2 lakh. A wants $2 lakh loan. What is B Inc.'s requirement? B Inc.'s requirement is $2 lakh in yen. Means they want to borrow in yen, which is equivalent to $2 lakh today. And the exchange rate is 120. So B wants to borrow 2 lakh into 120, 2 crore 40 lakh yen. 2 crore 40 lakh yen. These two amounts are equal today because of the exchange rate. Next, write down step 2, swap arrangement. When they are saying swap arrangement, if A requirement is dollar, then A will not borrow dollar. Then A will borrow yen. And B's requirement is yen. So against its wishes, it will borrow in dollar first. Only then swap will come. If A will borrow in dollar, then where is the need of swapping? If B borrows in yen, where is the need of swapping? So they have to first borrow in the other currency, which they don't want, and then swap with the currency which they want. So step 2 would be swap arrangement. A will borrow yen 2,40,000, 2 crore 40 lakh at 5% per annum from the bank and give it to B at 5 plus 1. This is given in the question. I have not done anything. The question says B will pay to A 1% over the yen loan interest rate, which the latter will have to pay as a result of the agreed currency swap. So B will pay to A 6% on the yen loan, whereas A has to pay to its banker 5%. Point 2, B will borrow $2 lakh at 10% per annum from bank. B will borrow $2 lakh at 10% per annum from the bank and give it to A at 9% per annum and give it to A at 9% per annum. Give it to A at 9% per annum. Now write down this in the form of a diagram. This will probably again help you to understand better. Diagram is not required in the exam. But today, for understanding purpose, we will write and follow these arrows which will now appear on the screen. Write down in the notebook diagram, diagrammatic presentation. Bank of A, B, this is Bank of B. Bank of A will give yen loan to A at 5%. First, A will borrow from its bank loan in yen 2 crore 40 lakh at 5%, which A will transfer to B. This loan they will transfer to B at 5 plus 1, that is 6%. 6%. A will borrow from its bank yen loan at 5%, transfer to B at 6%. Now come to B. B will borrow from its bank dollar loan at 10%, and then transfer it to A at 9%. If you can draw this diagram, this also helps you to get a very clear idea how are the transactions taking place. They will enter into loan contract with their respective bank and then they will swap their loan, and this way both parties will be able to save 1%, right? So then the question was in the last line, quantify the opportunity gain or loss component of the ultimate outcome resulting from the designed currency swap. So now we are writing this answer. What is the gain or loss to A and what is the gain or loss to B? You can write directly in the exam if we are running short of time, 1% to A, 1% to B. But then if it is an 8-mark question, it is better to write the answer in detail with all the steps involved. Serial number, particulars, amount. First we are computing gain or loss to A. Serial number, particulars, amount. First write down point number A. A will pay to its bank. A will pay to its bank 5% of 2 crore 40 lakh. That is yen 12 lakh, because A has borrowed yen 2 crore 40 lakh at 5%. And then point number B, write down A will receive from B. A will receive from B 6% of 2 crore 40 lakh. A will receive from B 6% of 2 crore 40 lakh, and that comes to 14 lakh 40,000. Then write down C, point number C. A also has to pay to B. These two transactions are swap deal. You receive and you pay. This is with the original banker, and these two transactions are swap deal transaction. So A will have to pay to B 9% of 2 lakh dollar, 9% of 2 lakh dollar, and exchange rate is 120, so that all the figures appear in same currency. So that comes to 9% of 2 lakh dollar into 120. Why we have multiplied by 120? All the figures will appear in yen. So this comes to 21 lakh 60,000. So this is outflow, inflow, outflow. So the question is, what is the net outflow, net amount paid in yen? net amount paid in yen will be A plus B plus C. So carefully take the total of these three items, negative, positive, negative, it comes to 19,20,000 yen. Then point number E is net amount paid in dollar equivalent. Ultimately A's requirement is dollar. So A will ultimately calculate my dollar equivalent payment. 19,20,000 divided by 120. 120 is the exchange rate. So with the swap deal, what you end up paying? $16,000. In the swap deal you end up paying $16,000. Point number F, write down interest payable by A without swap. Interest payable by A without swap, which means if A would not have entered into swap, how much it would have paid? Suppose it would have directly gone to the bank, taken dollar loan at 9%, then it would have paid 2 lakh into 9%, $18,000. Here you have paid $16,000. You would have paid $18,000. So how much did you save? Simple common sense. With swap deal we are paying 16,000. Without swap we would have paid 18,000. So we save $2,000. So the answer is gain $2,000. Gain $2,000. Just compare the two and write down. And a simple cross check. What is the cross check? 1% you have saved into $2 lakh. So that comes to $2,000. So this is one line answer actually. Because of swap deal, A is able to save 1%. So $2,000 saved. Now in the same way we will write down step 4. Gain or loss to B. Gain or loss to B. Serial number, particulars, amount. B has originally borrowed in dollar. So first 3 lines we will calculate in dollar, then we'll convert into yen. So point number A, interest paid to its bank. Interest paid by B Limited to its banker. 2 lakh into 10%, that is 20,000. Point B, write down interest received from A. These two transactions now are swap transaction. It will receive interest from B on $2 lakh at 9%, 18,000 inflow, and point C, interest paid to A. Interest will be paid to A on 2 crore 40 lakh yen, which is equal to $2 lakh, and the exchange rate has not changed, so don't worry about it, into 6%, so it pays 12,000. First transaction is with original banker. These two transactions are with A. It receives, it pays. Finally we have to see net amount paid in dollar. Net amount paid in dollar, A plus B plus C. 20,000 negative plus 18,000 and minus 20,000. So with the swap deal it is paying in dollar terms $14,000, but B's original requirement is yen. So ultimately they will compute in yen. So point number E, write down net payment in yen. Net payment in yen. 14,000 into 120. 14,000 into 120. Yen 16 lakh 80,000. Yen 16 lakh 80,000. This is what it is paying under swap arrangement. Point F, write down interest payable by B without swap. Interest payable by B two crore 40 lakh into 8%, 19 lakh 20,000 yen. This they have paid. This is what they would have paid, right? So they have paid much lower than what they would have paid. So the difference between these two is your gain. So point number G, write down gain 2,40,000 yen, and this also we can cross check. If you have understood the problem, both parties are able to save 1%. So cross check 1% of 2 crore 40 lakh is 2,40,000 yen. 2,40,000 yen. So both parties are able to save 1%. That was a very easy question asked in exam in May 2020 RTP also. Now we'll come to interest rate swap. We have seen currency swap. More popular question in the exam is interest rate swap. So what happens in interest rate swap? The parties will swap their interest obligation. Principal is not swapped. Only interest is swapped. And why do they enter into interest rate swap arrangement? So A have borrowed in fixed rate and B has suppose borrowed in floating rate. But A wants floating and B wants fixed. So, but for A, suppose only fixed rate is available, or it has already entered into a fixed rate arrangement. B wants fixed, but it has entered into a floating rate. If they prepay this loan, again raise fresh loan at floating rate, there will be prepayment charges, there will be issue expenses, lot of management's time, energy, efforts will get involved. So simple, they will swap their interest obligation. A will pay the floating rate interest liability of B and B will be paying fixed interest liability of A. So effectively A is now paying at floating rate and B is paying at fixed rate. So this way, without repaying their loan, without raising fresh loan, they are able to convert their fixed rate loan into floating rate or floating rate into fixed rate. And sometime this interest rate swap will be used to reduce your interest cost also. That also we will see with the help of some example. Now first thing, write down important for theory question also. They have asked in the past theory question on interest rate swap. And for your general information, this understanding of interest rate swap is very important for another subject in your course, financial reporting. There we have Ind AS on financial instrument. Okay, if you have studied, there are three standards: Ind AS 32, Ind AS 107, Ind AS 109. And there in the RTP or exam or your study material, they have asked question on accounting of IRS, interest rate swap. We will not discuss accounting today. It is not the scope of this subject. But the accounting of this interest rate swap, which is again very interesting and very important for FR paper also. I have observed that students find it difficult to understand the accounting of interest rate swap if they have not studied or understood interest rate swap here. So these two subjects are linked because lot of concepts which we learn in SFM, their accounting is covered in your FR paper in the topic financial instrument like currency swap, interest rate swap, option, future, forward rate agreement. What about the accounting? Somebody has to do the accounting also because these are transaction. So therefore the accounting part is also discussed in your syllabus in a different subject, financial reporting. So learn it carefully. What is an interest rate swap? It is a transaction involving an exchange of one stream of interest obligation for another. So one party pays fixed rate of interest, the other party pays floating rate of interest. Typically, it results in exchange of fixed interest rate payment. So most probably in most of the questions, one party will swap fixed rate obligation against floating rate obligation. So one party will pay fixed rate, the other party pays floating rate, but can it be floating to floating also? Yes, sometimes. Occasionally it involves an exchange of one stream of floating rate payment for the other. So this is called floating to floating, which is also possible. It may be linked to two different benchmark rate. So one party may pay interest which is linked to LIBOR, the other party may pay interest which may be linked to another benchmark, say MIBOR. So that is floating to floating, but this is only for a theory question. Normally they can ask you, and such swap which involves floating to floating is called basis swap. BASIS, basis swap, which involves floating is exchanged against floating, and fixed to floating is called plain vanilla. Very interesting name, plain vanilla coupon swap. Fixed and floating swap is called plain vanilla. Floating to floating is called basis swap. Now come to next paragraph. Because they are asking you theory questions also, then you can write down these important features of interest rate swap, and while solving the questions also keep this in mind. Even in your FR subject, keep these features in mind of interest rate swap. It effectively translates a floating rate borrowing into fixed rate. One example I had given, A Limited has borrowed at fixed rate, B has borrowed at floating rate, and they swap their interest obligation. So effectively A is paying now floating rate, B is paying at fixed rate. Useful for those companies which have borrowed at fixed rate, but now they think they should have gone for floating rate because market interest rate is falling. So instead of repaying the original loan, they can just swap their interest obligation. Second very important point, the net interest differential is paid or received. So on every settlement date, what they will do, they will calculate who has to pay how much and who has to receive how much, and only the differential amount is to be received or paid. Even in your accounting this will be useful. So A has to pay to B floating rate, and B has agreed to pay to A fixed rate. So they will calculate the interest. Let us say the notional amount is 1 lakh for easy calculation, and the floating rate of that period turns out to be 8%. So A has to pay to B 8,000, and suppose the fixed rate they have agreed to exchange is 7%. So B will pay to A 7,000. A will pay to B based on whatever floating rate benchmark rate they have agreed 8. B will pay to A 7% every time. So the difference is 1000. So what will happen? A will pay to B the difference of 1000. Maybe in the next year the floating rate is 6% and the fixed rate will remain 7 only. Fixed will remain fixed. So now A will pay to B at 6% 6000. B has to still pay to at 7% 7000. This time also difference 1000, but this difference B will pay to A. B will pay to A 1000. This way every period they may agree for 6 month settlement or 1 year settlement and they will receive or pay the difference. Important thing to note is there is no exchange of principal repayment. There is no exchange of principal either at the beginning or at the end. Only the interest is swapped, and that too only the differential is received or paid. So effectively you are able to convert your fixed rate obligation into floating rate obligation, or you get the interest rate in the desired format you want. Point number 4, understand this also. These are two parties, A and B. A has borrowed loan from bank. So this is one contract with the bank. Similarly, B has taken loan from bank. Look at the diagram for question number 2 we have solved today. This is one contract, original contract. At the same time, they are also entering into contract with each other. So this contract is original contract and this is another contract, swap contract. It is different from the original contract. It is structured as a separate contract distinct from the underlying loan agreement. So with respect to the bank, your liability to pay interest as per loan agreement with the bank continues. That will continue as it is. Every month or every quarter, every 6 months, you have to pay interest to the bank. But with respect to the counterparty in the swap arrangement, you will receive or pay the difference. So these are two different contracts. So while doing the accounting also, you will pay interest to your bank, one entry for that. You will receive or pay the difference to the counterparty, one accounting entry for that. It is applicable to new as well as existing borrowing. You can use interest rate swap for existing loan. That means you can convert your fixed loan into floating, or you can use it for new loan also. So if you want to borrow at floating rate but only fixed rate is applicable, then also you can use interest rate swap mechanism and you can convert your fixed rate into floating rate into fixed rate. There is one example also printed there. So let us have a look at the example. A has a borrowing of $50 million on which a floating interest of LIBOR plus 0.25% is payable. Y has a borrowing of 50 million on which a fixed interest rate of 10.5% is payable. X and Y enter into an interest rate swap transaction under which A agrees to pay to Y fixed interest of 10.5% and Y agrees to pay to X a floating rate of LIBOR plus 0.25%, and this way they are able to convert their interest obligation from fixed to floating and from floating to fixed. So this is X, this is Y. X will pay to its original lender. What it will pay to its original lender? LIBOR plus 0.25. London Interbank Offer Rate plus 0.25. So this he will pay, and similarly Y will pay to its bank, Y will pay to its lender. How much fixed rate of interest he has to pay? 10.5%. These are two original loan contract. But then X wants to pay at fixed rate and Y wants to pay at floating rate. So now what they will do? They will enter into a swap deal under which X will pay to Y 10.5%. X pays 10.5% to Y. So see how this will flow. X will pay 10.5% to Y and Y will pay that 10.5% to its lender. And then Y will pay to X LIBOR plus 0.25. So this way Y will pay, which X has to simply transfer to its banker. So effectively what is happening now? Effectively X is paying 10.5% now, because these two will cancel for X. Receives from Y, pays to the bank. But what is actually pays now, what actually flows out of its pocket is 10.5. And similarly, Y is paying floating rate. X pays 10.5, so this gets cancelled and then this is transferred to the banker. So what remains for Y is this payment made LIBOR plus 0.25 to X. So this is such a wonderful arrangement where at a very low cost you are able to convert your fixed rate into floating and floating into fixed, and this way you can save a lot of cost for your company. Such deals are usually arranged by intermediaries called investment bankers or swap bankers or big banks, right? Now I am going to give you another example of interest rate swap. Write down in the notebook heading, write down interest rate swap. Example 1. This example is for cost cutting. The example printed in your book was for converting fixed to floating or floating to fixed. This way you can manage your balance sheet. This example is for cost cutting. Example 1, two companies, write down A and B. A's requirement is floating. B's requirement is fixed. That means A wants to borrow at floating rate, B wants to borrow at fixed rate. If they borrow at fixed rate independently, A goes to a bank and says, I want to borrow at fixed rate. Based on the credit rating of A, bank says we will charge you 9%. To B, bank says we will charge you 11% fixed rate in case if you borrow at fixed rate. Then they also ask about floating rate. So floating rate is LIBOR plus 0.5% and B is LIBOR. Floating rate is LIBOR plus 0.5% and B is LIBOR. So who has a advantage in fixed rate? A. Who has an advantage in floating rate? B. But A wants floating, B wants fixed. So if they get to know about each other, just for example's sake, they will shake hand. They will say each other, A will tell B, see, I want floating, but I will borrow at fixed. You borrow at LIBOR. I will pay you LIBOR. You pay me 9%. So effectively what will happen now? A will pay at LIBOR and B will pay at 9%. So by entering into an interest rate swap arrangement in this example, A will save 0.5%, B will save 2%. Only for example, they may agree at some other ratio also. Okay. So write down a note below. A will borrow at fixed rate and B will borrow at floating rate. This is just an example to bring the concept first, and then more complication can be created. If A says I also want the same benefit which you are getting, then maybe the fixed rate will be transferred at a different rate. Right, A will borrow at fixed rate and B will borrow at floating rate and swap their interest liability and swap their interest liability. Then write down one small note below. In this swap deal, A will save 0.5%, A will save 0.5% and B will save 2%. In this deal, swap deal, A will save 0.5% and B will save 2%, full stop. However, they can agree on some other arrangement also. They can agree on some other arrangement also. Now write one more example. Example 2, which is little complicated, but such examples are asked in the exam, which I am going to solve or explain first. Example 2, write down. A similar example is there in our book, question number 3, but today, right now, we are just discussing this from the point of view of understanding interest rate swap. We are not solving that example right now. We will solve it neatly in a proper way. Look at this question A and B. Requirement of A is floating. Requirement of B is fixed. Fixed rate applicable. A 9%, B 11%. Floating rate applicable. 2A LIBOR and 2B LIBOR plus 0.5%. Question is interest rate swap possible? Is interest rate swap possible? Can A borrow at 9 and B will have to borrow at LIBOR plus 0.5? If the swap has to take place, first they will borrow against their requirement. A's requirement is floating, but for swap, A will first borrow at 9, B's requirement is fixed, but for swap transaction, first B will have to borrow at floating against its requirement, and then they will swap. So the question is whether swap is possible. Will A be interested in the swap deal? Some of you are thinking that swap is not favorable for A. A can directly borrow from market at LIBOR. Then why will A enter into a swap deal with B and pay LIBOR plus 0.5 to B? This is what most of you are initially thinking. But the thinking process has to be seen in a different way. Think of them as a team. Team always has more benefit than individual. Yes or no? Yes. If instead of B, A borrows at fixed rate, so how much is the saving? As a team, they will save 2%. Otherwise, B would have borrowed at 11, A borrowed at 9, so they save 2. instead of A, suppose B borrows at floating rate. So they lose 0.5% here. On floating rate they gain 2%. On fixed rate they gain 2%, but on floating rate they lose 0.5. Now here lies the trick. If they join hands, instead of B, A borrows at fixed rate. Instead of A, B borrows at floating rate. Together they can save 1.5%. Together they can save 1.5%, and then what they will do? They will decide to share this gain equally. So A will get a benefit of 0.75% and B will able to get the benefit of 0.75%. So this way, if the two parties they come together, they can save 0.75% each. How they will do it? A will borrow at 9 but transfer to B at 9.75. A will borrow at 9, but in order to gain 0.75, it will transfer fixed rate to B at 9.75. B will borrow at LIBOR plus 0.5, but transfer to A at LIBOR. That is what A would have paid in the market. So A does not gain or lose on LIBOR, but A gains on fixed rate 0.75. Look at from B. On floating rate, B borrows at LIBOR plus 0.5, transfers to A at LIBOR. So B loses 0.5% in floating rate, but on fixed rate, it pays to A 9.75. So B gains 1.25% on fixed rate, B loses 0.5 on floating rate, but still the net saving is 0.75%. This way they will enter into a swap deal. So I'll first make you write this discussion, and we are going to solve the same problem after one more time. So write down, the question was, is interest rate swap possible? So you say yes, it is possible. A will borrow at 9%. A will borrow at 9%, only then the swap process will start, and transfers to B at 9.75%, because both parties want to gain 0.75. So in this deal, here A gains 0.75, B will borrow at LIBOR plus 0.5, B will borrow at LIBOR plus 0.5 and transfer to A at LIBOR, and transfer to A at LIBOR. Now in the fixed rate here, B gains 1.25%. In the floating rate here, B loses 0.5. So let us quantify them. Next line, net gain to A. Net gain to A would be, gain on fixed minus loss on floating. Gain on fixed minus loss on floating. Gain on fixed is 9.75 minus 9. Loss on floating is not there. LIBOR, it would have paid, LIBOR it pays to B. So on the floating rate front, there is no gain or loss to A, but on fixed rate front, there is a gain of 0.75. So the answer is gain of 0.75 to A. Next heading, net gain to B. Net gain to B, gain on fixed rate minus loss on floating rate. Gain on fixed rate minus loss on floating rate. Think about it. If B would have gone to borrow at fixed rate, it would have paid 11. With the swap deal, it is paying only 9.75. So this difference of 1.25 here is the gain. On the LIBOR front, it is losing. It borrows at LIBOR plus 0.5. On the screen table, it borrows at LIBOR plus 0.5, and it transfers to A at LIBOR. So here there is a loss of this 0.5. So 1.25 gain on fixed rate and 0.50 loss is equal to 0.75%, is equal to 0.75%. This is the gain to be. So what otherwise seemed impossible, with swap it becomes possible and you are able to cut the cost. The only thing we have to check, as a team the gain is greater than loss. So if A borrows instead of B, gain 2%. If B borrows instead of A, loss 0.5%. So if gain is greater than loss 0.5, then you will always say swap is possible. And then we can arrange the deal. Now we'll take a break.